guess from an underlying point of view, we're fairly pleased with the underlying performance of the business. We've seen revenue up 3.5%, underlying earnings up 3.9%, nearly 4%, and of course group receivables up 32%. Receivables growth underpinning, of course, future revenues for the business. Reported profit impacted by three significant events, in particular the provision that we took earlier in the year for historic customer credit refunds following the retirement of a legacy IT system, the write-off of $6.7 million worth of goodwill attached to the NCML business from its acquisition in 2011, and of course costs associated with the strategic decision that we've taken to close our consumer finance business Cash First. And whilst those three events have had a negative one-off impact on the business, they are the right decisions to make, and they certainly support and underpin the organisation's focus on business activities that have the capability of delivering above average returns on invested capital. And we're seeing that start to materialise in the business finance division, which has doubled revenue and doubled earnings over the period, and we're starting to see improved returns as that business continues to scale up its receivables book. The asset finance business, Thorn Equipment Finance, has seen originations increase by circa 50% over the period. We continue to maintain diversified origination channels. We have a third of our origination coming from our direct channel, a third from brokers and vendors, and a third from strategic partners. And that's leading to a very broad diversification in the build of that portfolio of small transactions. Our average transaction value only $26,000 or so. That business remains very much focused on the underserviced markets of servicing small and medium-sized businesses. Similarly, our Thorn Trade and Debtor Finance business, formerly known as Cash Resources Australia, we've completed a very successful integration of that business over the course of the last 12 months or so. We've seen new client growth. We've purchased just on $370 million worth of invoices over the 12 months, which exceeded our pre-acquisition assumptions. And certainly the capability of providing working capital and growth capital solutions in addition to the asset finance products is certainly being very well received by brokers and vendors in the market, and positions Thorn quite uniquely in that regard. In the rental business, the core radio rentals business, no shortage of inquiry or demand. However, we are acutely aware of the evolving views of the regulator, in particular their views on responsible lending concepts and some of the vagaries that have existed in that context around what constitutes reasonable inquiry and how does the concept of scalability effect within the framework of that legislation. And whilst we're incredibly proud of our record low level of account delinquencies and record low levels of impairments, etc., we do understand that the regulator expects more be done right across the industry with regard to ensuring that vulnerable consumers are protected. And to that end, we introduced additional credit assessment measures in the fourth quarter of FY16. That has increased transaction times, had an impact on inquiry, conversion, etc. However, we have instigated a streamlined project to introduce interface technology platforms to reduce transaction times and improve the customer's experience. That, in turn, will also support the organisation's adoption of some of the recommendations, or in fact all of the recommendations that have been called out in the recently tabled Treasury Inquiry Report, and that will support the organisation to take a market-leading position in adopting pricing caps, etc., irrespective of what government takes office in July and irrespective of any timing delays to enact that legislation. That underpins our confidence to open new stores. We're opening a new store in FY17 in WA, another new store in Victoria, and we'll also look to transition 6 full-service branches, street shop locations, to high-footfall shopping centres. In the receivables management business, NCML, We've completed the restructure from 5 locations to 2 centres of excellence, a PDL Centre of Excellence based in Adelaide and a Contingent Collection Centre of Excellence in Melbourne. That restructure did lead to some cost savings as well as improved contingent collections. However, the improvement in profitability hasn't been sufficient to justify retaining the $6.7 million worth of goodwill on the books, and we've taken a decision to write that off. We have continued our investment in the PDL space. It is a competitive market. We've been incredibly selective about the portfolios that we bid for. We're only bidding for high-quality, forward-flow credit card style debt. We've been quite measured in that regard, and dovetailing that, we've continued our transition from a treatment path of focusing on discounted settlements to a treatment path of building interest-bearing arrangement banks, so treating it more like a receivables book rather than a pure debt collection exercise. Pleased to report that the contingent business is continuing to show early signs of recovery and growth, and in more recent months we've won a number of contracts both in the government and banking sector, so that's encouraging. In the consumer finance sector, this is an incredibly rapidly evolving marketplace, with the increased competition having an impact both on credit quality as well as customer acquisition costs. One of the key drivers that we have maintained within the group is a core focus on business activities that can deliver improved or above average returns on invested capital. And whilst we saw a moderate increase in the level of origination following the launch of a new origination platform late last year, those lifts, once plugged into our forecast, showed that we wouldn't reach the scale required to achieve the right levels of return in the next 3 to 4 years. So we've just made a pragmatic decision to close that business, and we'll look to redeploy that capital into higher returning business divisions over the next 3 to 4 years. So at a group level, I guess just to quickly summarise all of that, at a group level, the underlying business performing sound, with receivables growth underpinning future revenues, reported profit impacted by those 3 significant one-off items. The consumer lease business continues to receive strong inquiry and demand, well positioned to adopt the recommendations called out in the Treasury inquiry, and I think we'll be equally well positioned to potentially play a role in consolidating the market, as smaller operators will struggle to get access to capital or to recycle capital efficiently within the framework of the recommended pricing caps that have been put forward. The business finance division, very well positioned with effective and agile product suite, and obviously a model that delivers effective and efficient execution of that product suite. Closure of the consumer finance business so that frees up capital to invest in the higher returning business, refocuses management's attention on the core business divisions. All of that coupled with, of course, strong balance sheet, strong recurring cash flows, growth in receivables, an 8% fully franked dividend, very healthy core business, supports our position that we think we've got a very positive long-term outlook for the organisation.